In today's episode, I'm going to teach you the breaking news strategy that I use to capitalize on the volatility that occurs when a company puts out news. This is something that happens pretty much every single day. There are literally thousands of stocks in the market, but on any given day, usually there are a few of them that are putting out headlines that are substantial. One of the challenges that we face is that with all of these companies that are publicly traded, how do we know which headlines are going to potentially move the market? And which ones are, well, kind of negligible. They're not going to have any effect at all. So the way I do it is I look for stocks that are beginning to move. And once they're beginning to move, if they meet a certain set of criteria, then I'm going to consider this to be an opportunity that I need to jump on. I am going to give you a case study of a trade that I took just today. We had a stock that had breaking news at 8 a.m. Top of the hour, news comes out. Within 12 minutes, the stock is up over 133%, and I'm locking up over $6,000 of profit. Okay, my results are not typical, but this trade and all the other trades that I've taken in my career are great case studies of the strategy that I'm trading that works in the market today. My name is Ross Cameron. I'm a full-time day trader, and I'm probably best known for turning an account with less than $600 into more than $10 million of verified and independently audited profits. Although my results are not typical, they put me in the unique position to share with you what has worked so well for me in today's market. So let's go ahead and jump onto the screen share. This is my breaking news strategy, and I'm going to walk you through step by step from how I find the stocks, how I evaluate whether or not they have the potential to make a move, all the way to executing the actual trade. And today's trades will be a great case study for us to go over. So I'm going to go ahead and put this on full screen here. And we're going to jump in with step number one, the process of taking a day trade, and specifically on a breaking news strategy setup. Step number one, we've got to find a stock that's moving fast right now, and that meets my criteria for being worth trading. Something that's important to understand is that there are thousands and thousands of different strategies out there that you could possibly choose, and some of them will have different criteria for the stocks that are worthy of trading. For me, I'm a volatility trader. I look to trade stocks that are moving very quickly. And so at just a very basic level, my criteria for considering a stock to be worth trading is to have a stock that's up at least 10% on the day. I have found that this is where I make the most money on stocks that are up at least 10% on the day. And these are also the stocks that once they're up 10% have the highest likelihood of continuing to being up 20, 30, 40, 50%. Naturally, the stocks on any given day that make the biggest moves, the ones that go up 75, 80%, 100%, at one point were up 10%. So I kind of consider breaking 10% to be breaking out of that sort of standard deviation. Once you break 10%, then your odds of going to 20, 30, 40% are so much higher than a stock that's only up, let's say, 2% on the day. So my minimum sort of criteria for considering a stock is that it's got to be up at least 10% on the day. Now, one of the challenges that we do face is that with all of these stocks on any given day that have breaking news, what's our approach for finding the setup? Now, if you tried to read every news headline that came out, you would go crazy. There are companies that literally put out news every single day, but they're like really fluffy headlines. They don't really have any substance to them. There's no real value, and they certainly do not move the market. Okay, so trying to read every single headline, that's not even possible. That's not going to work. So what do we do instead? Well, what if we had a system where we could find stocks that were starting to move? Find stocks that were up at least 10%, and then from there, make a decision of whether or not it even has good news or what the news is and whether or not we want to buy it. That's the way to approach this. So the first step is to add some filters of specifically what we're looking for. Number one, we want to see a stock up 10%, certainly. Now for me, because I'm often trading in a smaller account, I'm going to want the price to be between $2 and $20. That means the stock is affordable. Of course, I want to see if the stock does have a news catalyst, but I can check for that later. I want to see, in addition, that the stock has high relative volume. Relative volume is a measure of the volume today versus what's normal. So let's say, for instance, yesterday a stock traded on 150,000 shares of volume, pretty light volume. And then today has 300,000 shares of volume. It would have a relative volume ratio of 2. It's trading 2 times higher. Now, if it trades on 1.5 million shares of volume, the relative volume will be a ratio of 10. If it trades 15 million shares of volume, the volume ratio would be, 100. And if it trades on 150 million shares of volume, of course, it goes up from there. And it's not impossible to see a stock that's trading on 1,000, 2,000, 3,000 times higher volume than average. And you have to ask yourself, why would a stock have, 3,000 times higher volume today than normal? That's because it has a news catalyst. It has news, and it could be really great news, and that's what's sending the stock to these new highs. Okay, so number 1, we're looking for the stock to be up 10%. Number 2, it's got to be priced between 2 and 20. Number 3, we want to see it's got a news catalyst. And number 4, we want to see high relative volume. Now, the good news is we can use a stock scanner to search for all of these things. This, and this are the easiest to search for initially, because sometimes the news headlines take a few minutes to sort of populate through market data vendors. So step number 1, finding a stock moving fast right now. I'm going to use these stock scanners. Now, these are stock scanners that I did develop. I have a development team that works for me. We built these out. And these are available to our Warrior Pro members at Warrior Trading. But of course, if you chose to use a stock scanner available from somewhere else, that's fine too. So I program in my filters to the stock scanner, and now the scanner's doing the work for me. It is now searching the entire market for stocks that meet my criteria. Now, what's going to trigger a stock to actually hit my scanner is when it hits a new high. If a stock hits a new high of day and is up 10%, is priced between 2 and 20, has a high relative volume, then it's going to trigger an alert. Now, additionally, the filters that I add to kind of tighten this up a little bit include the rate of change in the last 10 to 15 minutes, the amount of relative volume, I filter out some junk. When you start with very loose filters, then you're going to inevitably get some noise. And the tighter you filter your scanners, the better the alerts will be. However, if you filter them too tightly, you may miss some actionable setups, which you don't want to do. So there's definitely a sweet spot there. This is all, I've already programmed all of this, and this is how I've been using it for years without changing it. So this is a very solid set of scanners. Okay, so let's look at this stock, QNRX. It hits my scanner at 8:04 a.m. It's priced at $4.75. Now, what's interesting is that it only had 25,000 shares of volume when it first hit the scanner. That's not a lot of volume, but the relative volume was already 134. 134 times higher than average, which tells us this is a stock that usually doesn't have a lot of volume. But today it does, and it's already up 71%. This stock is moving very quickly. Now, there's another column here called float. Float is the number of shares available to trade. This is part of our supply-demand imbalance. So a stock that's going up 10%, obviously it's in demand. If it's priced between 2 and 20, it's going to be in demand by retail traders. If it has news, that's going to create demand. If it has high relative volume, that's a reflection of demand. So these all create demand. On the other side of demand, we have supply. So we've got supply here, and supply is represented by the number of shares. The number of shares is determined and is called the float. Right here, the float, it's determined by the company when they do their initial public offering. So when the company sells shares onto the market, from that point forward, that's the number of shares available to trade. Okay, so what happens for a lot of these companies, especially lower priced companies, is they'll IPO, for instance, IPO at $10 a share. They'll IPO at $10 a share, and they'll sell maybe 3 million shares. Okay, so they've raised effectively $30 million in their IPO, $30 million, and they have a 3 million share IPO, or a 3 million share float. That's the float. But over time, the company, declines in value. It's a new company. They're not very profitable. It's declining in value. And eventually it gets down here where it's, let's say, 80 cents a share. uh-oh, that's a problem. It's a problem because to remain listed on NASDAQ or the New York Stock Exchange, these companies have to keep their stock price above a minimum of $1 a share. Now, if they dip below $1 a share, they can remain there for a little while, but they will eventually get a letter of non-compliance, and the company will either get delisted from those big exchanges down to the OTC market, which is where there's a lot of penny stocks, or they have to get their stock above $1. So what these companies will typically do is they will do what's called a reverse stock split. So a traditional stock split is when Apple is $700 a share and they do a 7-to-1 split and it goes down to $100 a share, which makes the stock more affordable for retail investors, which is great. Now, a reverse split does the exact opposite. It takes a stock that's at 80 cents and a 10-to-1 split will move it, 80 cents. Let's see, 10-to-1 split, it's going to move it back to $8 a share. And so the next day you're going to log in and the stock is at $8 a share right here because of the reverse split. So reverse split takes effect here. Now, what this does is the price goes up, but the market cap can't go up, right? $8 a share times 3 million shares. Now you're back at a high market cap. That can't happen overnight. So what they do is they divide the number of shares available by the ratio of the split. So here, this stock now goes down to a float of 300,000 shares. Now, over the last 2 years, we've been in a market where we have seen small cap stocks get really beaten up. There have been hundreds and hundreds of small cap stocks that have dropped 70, 80% over the last couple of years and have had to do reverse splits in order to get their stock price to stay above $1 a share. This has had the effect of reducing the float more and more and more and more, which means the level of supply for a lot of these stocks is tiny. Now, a lot of these companies are starting to put out some solid headlines, and that's because the overall market and the economy has been turning around. So when we get one of these headlines, it is not unreasonable to see a stock with really strong demand go up 50, 100, 200% in one day. In fact, we've recently been seeing moves in the 800 to 1,000% range in a single day. This is the power of breaking news. And so there's no question that if you have a strategy to capitalize on these types of moves, you're going to do better than a trader who doesn't. All right, so step one is to find the stock moving. And it's not enough just to find the stock moving. You also have to be able to qualify that it's a stock worth trading. INDP is another stock that hit my scanners a little bit earlier, but I was very quickly able to rule it out. Although on the surface, you would probably say it looks similar. It's a little cheaper, similar volume. The float's 6 million shares instead of 960,000. But overall, it's somewhat similar, except for the fact that when I did my next step of due diligence, I wasn't happy with what I saw. Step 2, check the catalyst. So step number 2, I actually have to check what the headline is. Now, one of the problems in this market is that we have a lot of high-frequency trading algorithms. What these algorithms do is they attempt to read news headlines that come out and instantaneously execute market orders. So when news comes out on a stock, news comes out, it's 8 a.m. right here, and the first thing that happens, instantly you see this big green candle form. And this big green candle is formed by high frequency trading algorithms, HFT. They just instantly execute buy order, buy order, buy order, buy order, because the stock met their criteria for being worthy of trading. And of course, they've automated all of that to computer systems, incredibly sophisticated computer systems. But sometimes when I actually look at the headline, I'll realize, I don't know, this is kind of a fluffy headline. I'm not sure if it's significant. Now, in the case of QNRX, I wasn't sure how significant it was, but it did seem to me to be a valid headline. All right. So announces FDA clearance to recruit teen subjects into both ongoing, whatever this syndrome is, clinical studies. All right. So we've got a catalyst. The stock is moving higher. That's what's important. All right. Step number 3, I need to analyze the daily chart. So obviously, I don't proceed to the next step if step 2 doesn't check out. If I don't like the catalyst, then I'm not going to proceed to step 3. But if I like the catalyst, the stock is moving up, proceed to step 3. So step 3 is to analyze the daily chart. So QNRX is a perfect example of a stock that about a year and a half ago was up at $34 a share and has sold off all the way down to $2.77. Right here on the chart, we see this S, which refers to a stock split. And we know it wasn't a traditional stock split. It was certainly a reverse stock split. One of the first things I look at when I'm analyzing a daily chart is whether or not there's nearby areas of resistance and how far away the 200 moving average is. The 200 moving average is this purple line, and it is very far away. So the 200 moving average is at like $15 a share, which means this has a lot of room before that first level of chart resistance from a moving average. Now, I also always look to the left, so my eyes look left, and I'm looking at recent big candles. Do I see any really big red candles? Certainly back up here in this area, but not more recently. I do see this green candle, however, and I look at the high. I look to the left, and then I realize that there's no other resistance until the low of this candle. On this day, the stock closed low and opened substantially lower the next day and continued selling. This is a setup where we have on the daily chart what's called a gap. A gap occurs when a stock opens significantly higher or lower than it closed in the previous session. Today on QNRX, this is a daily chart that I took pre-market, but once the market opened and began trading, the stock opened here at like $6 a share. So we also had a gap on today's chart as well. Now, when we have a gap, that's an area that really doesn't have any resistance at all. So if a stock can start to get into this area with no resistance, you can sometimes see a move all the way to the top of the gap. So what I recognized was that this stock had room from $12 to $14.28 with no resistance. And between $5 and $12, well, there really wasn't anything super significant in this area that stood out to me. So that was good. In other words, the daily chart checked out, and I proceed to step 4. Step 4 is to analyze the level 2. So this is where I pull up the actual depth of the market and try to make a decision of whether or not I'm going to take a trade. When I pull up the level 2, what I have right below the level 2 window is my order entry window. These two go hand in hand. So I'll show you what my order entry window looks like here. All right, so my order entry window looks like this. I'll put it up right here. Looks like this. Right below my level 2 window is the order entry window, and I have it sized so they're pretty much the same. All right, so they're both like right in this area. And all I have to do, oops, we'll just go back here. All I have to do when I pull up a stock, I look at the level 2, and then all I have to do is click the buy button. I click the ask price. It'll automatically populate right here in the price. My share size is automatically populated for 3,000 shares, and then I just click the buy button. So the process that I go through when I pull up the depth of the market is I look at the spread, the thickness or thinness of the market, and the order sizes. So in this case, we see that we have 562 at the bid and 566 at the ask. For those that are unfamiliar about how level 2 works, the stock market is an auction. At any time, there are people that are bidding and there are people that are asking. So there are people involved in the stock that are bidding because they want to buy it at a bid price of 562, and there are people that are holding it and want to sell it at 566. This creates what's known as the spread, which in this case is only 4 cents. Now, this is a screenshot that I grabbed a little later in the morning when the volume was already up to 4 million shares, when it was up 100%. So when I first pulled the stock up, the spreads were a little larger, about 15 cents. But one of the things that I look at is to see, is there any really big noticeable buyer or seller? You know, if I saw, just for instance, a 300,000 share seller right here, you know, a huge seller, 300,000 shares, I would be like, wow, okay, at $6, there's a 300,000 share seller. That's a really big seller relative to the amount of volume traded on the stock, right? It's almost 10% of the volume in the whole day is in one order sitting on the offer. So that's going to create overhead resistance. On the flip side, if we saw a 300,000 share order on the bid, that would create a perception of support. So I look at the spread and I look at the thinness and thickness of the market. A thick market will be a stock, and I'll show you a thick market just as an example. This is a thick market, Bank of America. This stock is trading with a 1 cent spread, and there are, thousands and thousands of orders on the bid and the offer. It moves like a snail. It's a very slow moving stock. This one's just not one that's going to go anywhere anytime quickly. Then you have DWAC. This one's Truth Social Special Acquisition Company. This one right now has like a 20-cent spread, 30-cent spread. Bigger spreads. This is a stock that can move very quickly. It's up 13% today, which is $4 a share. So from $39, $38 a share up to $44. And it's a stock that could go up to $48, $50 a share in one day. We don't see any really large sellers on the level 2. We do see a larger spread, so it's a bit of a thinner market. That's good. That's not a bad thing. Now, there is such a thing, certainly, as a market that would be too thin, a stock that has just zero liquidity. You wouldn't be able to get in or out. I don't have a good example of a stock like that off the top of my head. They're not stocks I would usually pay much attention to. Let's see. Yeah, I just pulled up a couple, but neither of them are really that thin. In any case, so this is the next step, to check the level 2 for spread, thickness, order size, and then I can watch the time and sales right here to see if other orders begin coming through. When I see an order in green, that tells me that, okay, someone is executing orders right there in real time. So if we look back at DWAC, this is level 2 that's actually flowing, you'll see periodically we've got some orders in green. So I perceive those, when they're in green, it means the order took place at the ask price. And if they're in red, the order took place at the bid price. At the ask is strong, at the bid is weak. Orders in white go through in between the spread, which is somewhat neutral. Now, neutral can also be considered weak if you've had a stock that's been making a nice move up and now suddenly the price action is looking neutral, because that means we're probably going to reverse. So red is certainly bad, but neutral is also not great when you've had a stock that's been moving strongly. What you really want to see is green and lots of it. So when I'm first looking at taking a trade, I'm checking the level 2, I'm looking at the time and sales, and I want to see that there are a lot of people that are buying this stock that really like it. Okay, so once I see that, the next step is to look for an entry on the 10-second and the 1-minute chart, and I've got to use 2-to-1 profit-loss ratios. Okay, so we're going to pull up the chart here, and let's talk about this for a moment. In the case of QNRX today, it initially pops up, as you see, on these 2 big green candles, and then it has 2 red candles that pull back. So if we draw this on the whiteboard, so we can kind of break down the anatomy of it, we have 2 candles that pop up, and then we have 2 candles where we get a pullback. So I would speculate that these first 2 candles were primarily high-frequency trading algorithms. So HFT algos. They create that first pop. And then there's a little bit of profit taking here that occurs from traders who maybe were in the stock before this happened, who have just been holding for a while. Or it could be people that are either short selling or people that, or maybe the algos themselves are taking profit. There could be some people who are retail traders who got in, took some profit, but you'd have to be very, very quick, and that's not as likely. So what's more likely is that you have the algo spike, and then you have some people that were holding, taking a little bit of profit. They're like, oh, wow, okay, I can get out of this with a little profit. And then the question is, do retail traders come in? So when the stock is squeezing up right here, how do I know about it? As it's making new highs right here, it's going to be hitting my high of day momentum scanner. That gives me a chance to pull up the stock and begin doing my process of due diligence. What's the float? What's the price? What's the news? What's the daily chart look like? And what's the intraday chart look like? If I like all of that, then as it's pulling back, I'm already looking at the level 2, and the only thing that I need to see is green on the tape in order for me to press the buy button right here and then look for that next leg up. And that's exactly what happened on the 10-second chart. We have the initial pop right here. We squeeze up. So initial pop, we squeeze up. We have 2 candles of pullback, and then right here, it goes higher. So from $4.50, it squeezes up to $5.50, $5.60. That's over $1 a share right there in 20 seconds. That is an impressive move. So that right there, I traded right in here and I made money. On that first trade, I made about $3,000. It's not a home run, but it is a solid base hit. The setup was simply looking on the level 2 for the green to come in, and then that created that first candle to make a new high. As we broke new highs, we surged higher, and in these moments right here, the stock is once again hitting the high day scanner. It is our leading percentage gainer of in the entire market of the day. This stock is now becoming obvious. Now this proceeds to sell off for 2, 4, 5, 6, 7, 8, 9 candles in a row. And to be honest, I was surprised. It sold off so much that I decided to buy this dip at about $3.96, right underneath $4, because it had sold off over $1.50 a share. I thought at this point, we're probably due for a bounce because this is something that's very common. When you have 2, 4, 6, 8, 10 candles in a row that are red, I start to look for a bounce. So this is one of the things that is worth noting here is that when I took this trade, this was a reversal trade. It's a counter trend trade. The short-term trend here is 8 red candles in a row. It's selling off. So that's a specific setup within the breaking news strategy. So the breaking news strategy calls for actively trading a stock that is moving right now on breaking news. But the individual setups I can trade will vary. I could do a reversal trade as I did right there, or I could do a micro pullback. My first trade was a micro pullback, buying the first pullback. My second trade was a reversal trade. So I got in down here at 4, and I was really impressed when this bounced back up and squeezed all the way up to $7 a share. That was a really strong bounce. That was super strong. Okay, so I broke the ice with my first trade, got my second trade right here, and now this is a strong stock, so I'm looking for more opportunities. So the dip trade at $3.96, just under the whole dollar. And by the way, for those of you that are newer, something that you'll notice is that a lot of stocks trade with respect to half dollars and whole dollars. So when this first popped up, it popped up to what level? $4.50. It then pulled back and it squeezed up to $5, and then hit $5.50. And it broke above it, but it couldn't hold above it, and it came all the way back down. And then it sold off, rather surprisingly to me, all the way back down here to about $4. So it essentially dropped through $4.50, and then it came to $4. And this is where, as it dipped below this level, and then I saw finally some green on the level 2. Seeing the green on the level 2 was enough for me to say, you know what? I'll take a starter right here. Let's see, right? My stop naturally on this trade is the low of this pullback. So I have a very tight stop, and let's see what it wants to do. And it ends up, as shockingly going all the way up to $7 a share. But what I really want you to understand is that a lot of these stocks trade with respect to half dollars and whole dollars. Now, to be able to really capitalize on this type of trading, you'll have to be really good at reading level 2. Reading the tape, being able to visualize that flow of volume, the flow of trading. So what charts give us? A stock chart is historical price action. This is what's already happened. We don't yet know what's going to happen next. When we look at this chart, this is all what has already happened. This is over. What is coming next? And what we can't see from the chart is the actual orders that are stacked up in real time. So on the bid and on the offer, anytime we have orders stacked up, and that's helping me predict what's going to happen next. So when I all of a sudden see we've had this sell-off of 8 red candles in a row, and then I see green on the tape, the green on the tape, I'm even going to see that order. I suppose I would see it the second it happens, I'm going to see the order go through. That doesn't necessarily correspond to a green candle just yet. The candle could still be red. The stock could still be selling off, but then suddenly, a 10,000 share green order goes through. So if I wait to see the reversal on the candlestick chart, I'm going to be behind. I'm going to be missing it. So I'm watching the tape, the level 2, and when I see that green starting to come in, boom, that's when I'm punching it. So the better you get at reading level 2, and ultimately the better you're going to get at trading these types of fast moving stocks. So in the case of QNRX, it sells off, it then squeezes all the way back up to 7, and then I start looking for the next area of resistance. All right, number 6. Once I've established a profit cushion on the day, and I did on this one. First, I got myself up 1,000, then 1,500, 2,000, and 3,000. I'm going to scale up share size to maximize on the opportunity if the stock is strong. Now, when I first start taking a trade on this one, when I got in at 450, I had no idea if the stock was going to go to 7 or back to 4. Right now, obviously, I had a suspicion based on my experience in the news that the stock was going to go higher. But even when it got to here, I did not expect it would drop to $4 a share. So it was the right move for me to sell and take profit up here, let it pull back, and then look for the next trade. So the way I'm trading is my first order of business is to generate a little bit of profit to create a cushion. I trade every single day as a goal of trading for income. My goal is $5,000. I would like to hit $5,000 a day. That's not going to happen every day, but it first begins with building a cushion. So once I'm up $1,000, then I feel like, okay, I've got a little cushion today versus being 0 on the day. And let's see if I can lean in. We've got some momentum. And so in the case of QNRX, I got my cushion, got myself up $3,000 over the course of several trades, a trade in this area, a trade in this area. There might have been a little trade in this area. And then I'm starting to look for the next setup. So I started getting dialed in on $7. 7 was the whole dollar here where we have this blue line. And we had resistance at 7 in this area. There was resistance right there. And then we popped over 7. So I took this trade here for the break of 7. Unfortunately, it did not hold. It flushes down and I got out. I got out very quickly with a small loss, and that's not a problem. It sells off. It comes back up. And I'm looking to get back in if it can break through 7, but it doesn't. It sells off again. It comes back up, it pulls back again. It comes back up. I take another trade right here as it breaks through 7. As soon as I'm seeing that green on the level 2 at 7, and it looks like it's going to break 7, I jump in and it pops right here up to 767. That's 67 cents in one trade. 67 cents. That's a good trade. All right, so now I've got a little bit more cushion on it. Now I'm up about 4,000. It ends up going through this period of sideways consolidation right in here. And this was very interesting. In here, there were a lot of people selling. And they kept selling, but this did not want to break. There was a buyer at $6.30 that was absorbing shares. I couldn't tell how many shares they were buying, but they were buying a lot of shares. So it sold off here. And then on this green candle, I said, you know what? I'm going to take a starter because it's not breaking down. It's holding up. It pops up for a second, and then it comes back down again. It sells. It looks like it's going to break. It doesn't. I said, I'm going to add to the position. So now I've got 8,000 shares of this. This is at about $6.50, and it rips up right here to 7. And at this moment, I thought we might go back to 750 up to 8. Now, it ended up hitting 7 and once again breaking and rejecting. When it couldn't hold 7, I took that off the table and locked up in total about $2,000 more profit. So I got myself up from $4,000 to $6,000 of profit on that move right there. And when it rejected this time and actually broke below 630, at that point I said, I'm done with the trade. The fact is, on this stock, within 3 minutes, it was up 133%. And within 12 minutes, it peaked at 175% on the day. So this was a really volatile stock. Now, this was amplified by the fact that the float was only 960,000 shares. When you have a stock that's a float that's that low, think about that for a second. There's only 960,000 shares for sale that are available. Not exactly for sale. They're available to trade. Now, some of the people holding those shares, they're not selling. They're not buying and selling. So their shares are, you could almost say they're effectively locked up. However, depending on which broker they trade with, their shares may have been lent out so someone else could short against that stock. So those shares are still potentially in rotation and available to trade. But nonetheless, you've got 900,000 shares as the float. And that means if every single one of the people that owned that stock wanted to sell it today when it was up 150%, they actually could have, because it's had millions of shares of volume. As of right now, let's see, I'll pull up QNRX just to check the volume on it. As of right now, it has 23 million shares of volume. The float's only 960,000 shares. That means the entire float, all of those shares, have traded hands 23 times today. That is incredible. So anyone that was in earlier from weeks ago, they easily could have sold today because there was so much volume. And it wouldn't have even really affected the stock price that much because there was that much volume. So this is what's really good to see. When you have a stock that has a low float and volume comes in, you can get a really big move. And you don't have to worry about an insider dumping a ton of shares because generally speaking, when you've got a low float and you've got that much volume, it can be absorbed. But there is one potential flaw. The potential flaw is if the company has what's called a shelf registration. And that's very common with a lot of these small cap stocks. A shelf registration means they've registered to sell more shares on the market. It's not an initial public offering. It's called a secondary offering. So in a secondary offering, they could choose to sell another 5 million, 10 million, 20 million shares if they want to. A lot of times these companies will automatically register a shelf that gives them the right to raise up to $100 million. So that could be a lot of shares potentially. Now, they'll try to work out deals to sell these shares to institutional investors. And usually when they do that type of secondary offering, the institutional investor, well, they want something in return. What they want in return is to get the stock for maybe 50% of its current trading value. So what we will often see with these companies is, and this is especially true when the company has had a long history of selling off, the chart will look like this. You've got the long period of selling off, price declining, reverse split here, and then the stock has news here, and it squeezes up here. All right, it might squeeze up, 400%. You never know. It can make a big move. It squeezes up, but this company, as a company, still has a problem. Their balance sheet is garbage. They're running out of money. They need to raise money. And so as the stock squeezes up, they already have that shelf registration and they know they're going to hit it and sell more shares. Now, they could sell shares directly on the market. They could sell 5 million shares directly on the market. They have the right to do it. And so if we see a stock that sells off all day long, it's usually not because insiders are selling. It's because the company is actually selling. So this is a risk. And this is why I'm not going to get married to any of these companies. I'm not going to hold them and hope they make a big move, but I am going to trade them. And the reason I like trading these low price stocks is because they've sold off for so long and they can bounce up 50%, 100%, 200%, 300%. You have a big company, like Apple or something like that. They can put out news and they can have higher relative volume, but how much are they really going to go up in one day? 5%? Maybe 8%? Rarely will stocks like that go up 10% in one day. And so as a retail trader that doesn't have a, huge account, because I don't keep a big account for day trading. I keep my account small, and then the day trading profits I make, I put away to invest long term. That's lower risk. People who try to day trade with $10 million, $15 million accounts, you can make some huge mistakes. I don't want to empower myself to ever make that kind of mistake. So as part of my risk management, I keep my account small. But that means I need to trade the type of stocks that have the potential to go up 50, 100, 200% if I really want to grow my account. By the way, I began this year with $116,000 in my account, and it's already over $250,000. My account has already doubled just in the last 6 weeks. All right, last 8 weeks. Okay, so that's my focus, to trade those types of stocks. But I don't want to get married to them. I don't want to hold and hope because they can be at risk of secondary offerings. Now, what we also know is that these companies can be targets for naked short selling. This is something that was exposed during the Wall Street bets, GameStop, Reddit kind of saga that happened in 2021. But the fact that these companies, these hedge funds, will short. They will try to beat down a lot of these not very strong companies. But what they're doing is they're really bullying the stock because they're able to sell shares that don't even exist. So it's like printing shares that don't exist so you can sell it and devalue the company. It's just diluting the value of the company when you just sell, 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 sell. It shouldn't happen. It's not supposed to happen. But as the insiders have said, it happens every single day. So we do want to be careful. Now, one of my focuses here with trading these types of stocks is to trade it aggressively when it's on the front side of the move. How do I know the difference between the front side and the back side? Step number 7. I'll slow down or stop completely once the MACD, the moving average convergence divergence indicator, has crossed on the 1-minute chart. And that happened right here. So when we get that crossover, and this was sort of dramatic because we had this pop up here and then this rejection. But in any case, right here was where the MACD crossed over. So at that point, I look at this as being on the backside of the move. Now, it is possible that the stock could get back up above VWAP and start to squeeze higher. But by the time that happens, the MACD is going to cross positive. So I want to be trading when the MACD is in favor of the trade, the average is above the signal line, and I want to avoid trading it on the backside of the move. It doesn't mean I'll never trade on the backside of the move, but I want to do it with more caution. So I avoid giving back too much of my profit, because what I've often found is that when I start over trading the backside of the move, this is when it's choppy. This is when it's difficult. You've got a headwind. So I'd rather trade when the momentum is on my side, when I've got a tailwind. And this is when we had, for sure, the biggest moves. So I use the MACD on the 1-minute chart. I don't use it on the 10-second. I don't even use it on the 5-minute. I just use it on the 1-minute. And for me, it's been a great indicator of front side of the move versus back side of the move. So the process of taking the trade from step 1 through step 8. Step 8 is analyzing my results and to update my journal. This is super important. For those that don't know my story, my turning point came because I was tracking every single trade into my spreadsheet, into a trading journal. I got to a point where I basically hit rock bottom. I had a huge loss, and then I had to go back to the drawing board, and I was like, what am I doing right now? Because this is insane. I keep losing money. Even on stocks that are making big moves, I'm losing money. What is wrong with me? And so I took all of my trades, and I started sorting through them and trying to figure out, what am I doing right and what am I doing wrong? Now, here's a tip. A mistake that I was making was that I was trading probably 12 different strategies at the same time. I was trading breaking news, and I wasn't doing it well because I was trading it on large cap stocks. I was trading breaking news on IBM, Apple, Pfizer. These stocks didn't give the 10% moves. So I would just get chopped up probably by the high frequency trading algorithms and the institutional traders. I was just throwing them my money. So breaking news ended up working later once I figured out the right type of stock to apply it to. But early on, it wasn't working. I was trying to trade options. I was trying to trade large caps just outright. I was trying to do reversals. I was trying short selling. I was trying swing trading. I was doing a little bit of everything. And the problem with doing that for me was that it muddied up my results. So I couldn't actually tell that there was a subset, like one single strategy that I was trading, that was working profitably. Well, it wasn't until I went through all of my trades and started really categorizing and saying, well, what setup was this? What setup was that I discovered a pattern that for me was working. And then once I took away all the strategies that I was losing money on, all I had left was the one that was working. And that was enough for me to turn the corner. So what I want to do for you guys is there's going to be a link posted at the top of the comments, pinned, and linked in the description, where you can download my small account strategy PDF. This is a PDF that outlines the small account strategy that I use every time I reset my account down to $500 or $1,000. It's the stocks I trade, it's the setups I trade, it's my process in detail. So if you want that, I would encourage you to download it. One of the things that I would remind you is not to try to reinvent the wheel. I'm just one trader, but I'm a trader with a proven strategy. So if you really want to master the strategy that I trade, you might as well learn as much as you can about it. And don't try to reinvent the wheel. Don't try to do something different from what is already proven to be working. You got to figure out the difference between what I'm doing and what you're doing, and then try to bridge that gap. Okay, so number 8 is to step back, analyze your results, update your journal, and then make sure you walk away and do not overstay your welcome. I always ask myself, was this the most obvious stock today? The answer today is yes, absolutely. The most obvious stock today was a stock that not only fit within my strategy, it was priced pretty much perfectly between 2 and 20. The volume was fine. The float was great. The gap, I mean, everything about it was good. Some of these stocks will go up 1,000% on a very similar set of characteristics. Others will not. And the difference there can be whether or not the company's in need of selling shares, tapping their shelf registration, so on and so forth. But from a just technical perspective, this lined up perfectly. And did I trade it well? The answer is yes, absolutely. $6,137 in 12 minutes. Yeah, I can't complain. That was some solid trading. But could I have done better? Let's be honest. I want to be careful of simply judging my day based on my result. Just because I'm green doesn't mean necessarily I traded well today. I could have broken all my rules. I could have chased it. I could have taken way too much size and made money, but it would be lying to myself to say it was good trading. But in the case of today, I can honestly say that I traded it very well, but I could have done better. I could have traded it with larger share size from the beginning. My entries and exits were great, but had I traded with larger share size, I could have made more money. Now, that's true with probably anyone, but I could have scaled up and traded with bigger size and made a bit more money. I could also say that there were more opportunities on the backside post MACD cross, which I avoided. That was the safe bet, but when you have a stock that's moving and is really volatile, sometimes you want to try to squeeze as much as you can out of it, and I think I could have squeezed a bit more out of it. Some of those were really nice dips off of ascending support that were on the backside, which I avoided. But again, I think I did leave a bit of money on the table, both in terms of not taking as large of share size as I could have, even relative to what I've been trading in the last couple weeks, and by cooling off on it a little too soon. So I could have done better, but at the same time, I'm green, and that's good. It's just, I think, valuable to spend some time reflecting honestly on your trades, because look, the goal is to continue to get better and better and better. And even though I've been doing this full time for more than a decade, I still see room for improvement in myself. I'm not the best trader out there. There's a ton of people that are better than me. So I want to try to always get better. The better I get at solving this puzzle every single day of finding the right stock, of actually having the confidence to execute on the trade early and with bigger size, the more money I'll make. So there's a lot of motivation to try to do better. The potential is, well, sky's the limit. So I'm going to keep trading. I'm going to keep focusing on it. And I encourage you guys to make sure you download my small account strategy PDF. And if you found this episode helpful, I hope you hit the thumbs up, and I hope you subscribe to the channel for more episodes just like this on day trading strategy. And you know what? Since you watched to the end of this episode right here, YouTube thinks you might just love this one right here. So make sure you check that out, and I'll see you for the next upload real soon. All right, I'll see you guys soon.